Hi, my name is Daniel Dalmolin, and I'm a financial advisor with Global Financial Consultants. Today, we're going to talk a little bit about superannuation. The question today I'm going to raise and discuss in this topic is: should we be using our super in Australia as a vehicle for savings of retirement income? Generally, us Australians, when we move overseas, our superannuation contributions stop as well. That main reason for that is that employers make those contributions, and when we leave Australia, they stop making those contributions, and that's where we leave it. So we're going to dive a little bit into superannuation and answer some of these questions. Types of contributions that you can make to your super account. The first one is concessional contributions. If you have a local assessable income in Australia and you make out a tax return, you can make a concessional contribution. You may want to review contribution strategies even if you don't have a local assessable income, but it's important to be aware of tax implications of doing so. The current annual concessional cap for concessional contributions is $27,500. For making concessional contributions, you need to prompt your superannuation managers to say that you're making a concessional contribution so that they take that into account, and you should be making that before the end of the financial year. Now, when you're making concessional contributions on local assessable income, you cannot have a negative tax return. Your tax returns have to be positive or zero. So let's say, for example, you have an investment property in Sydney and you have positive net income. You, instead of paying the 32.5% tax on that income, you can make a contribution as a concessional contribution and bring down that amount. But the final tax return that you lodge cannot be negative. It has to be a positive return. If you have a super balance less than 500,000, since the 1st of July 2018, you can bring forward up to 5 years of unused concessional contributions that you haven't used under the cap. Let's say, for example, Kate, who has an investment property, she makes a concessional contribution in 2021 financial year for $10,000, and then she makes another concessional contribution in 21-22 financial year for $20,000. She would be allowed to bring forward the $15,000 from the 2021 financial year and the $7,500 that she never contributed in the 21-22 financial year, and use those up as concessional contributions. The other option to contribute into your super fund back in Australia is called a non-concessional contribution. Each year, the cap on your non-concessional contributions are $110,000. So at the end of the year, if you receive a good bonus, you can use the non-concessional cap to put that money away into super. Now, since 2021, they have allowed us to bring forward the next 2 years of non-concessional contributions and make a lump sum payment of $330,000 into our super fund. But note that before you make that contribution of $330,000, you need to make sure that your transfer balance cap remains below the $1.9 million cap. So how much do we pay on contributions to our super fund? So if you're working in Australia and you are contributing to super, or your employee is contributing to super, you pay 15% tax on all funds that go into your super account. Now, generally, if you're working in Australia, you'd be paying 37 cents in the dollar or 33 cents in the dollar, depending on your salary. So being taxed on your super contributions as 15 is taken as an incentive for people to put money away into super for later on in life. In general cases, if you're below 60 years old and your superannuation is what they call in the accumulation phase, capital gains within your super is taxed at 15%. That means your super fund buys and sells shares. When it sells the shares, If those shares are sold within 12 months, it'll get charged 15%. Now, if your super fund holds the shares for more than 12 months, you effectively get a third discount. So instead of 15%, it's charged at 10% tax. And dividend income is also charged at 15% tax. Just remember, in the case of concessional contributions, if you make a contribution to super as a concessional contribution early in the year, and a few months later you have a large capital gain of more than $250,000, even if you're not working in Australia, it'll attract an extra 15% tax on that super under the rules around Division 293. One of the benefits of owning Australian shares within your super fund is that most public listed shares in Australia pay franked dividends. So franked dividends means that although you receive a dividend within your super fund, the dividend comes along with a franking credit, and the franking credit is 30%. So generally your tax on dividend income in your super fund should only be 15%. So the franking credit offsets that 15%, and you use the balance credit within your super fund to offset other income. So there is a bigger benefit using or investing in Australian shares. So I hope that I've given a bit of an explanation as to the options of investing money in your superannuation account, how your super fund taxes income, and then also some of the benefits of investing in Australian shares within your super fund, caps, concessional cap, non-concessional caps, and in case you contribute a lot to your super fund and you also have a large capital gain, just be careful. Very happy to answer any questions about these topics. Of course, anything to do with superannuation contributions, you need to bring your Australian tax agent involved, as he will be doing the paperwork later. But any other general questions about advice, if you'd like to contact me, I have my details below: phone number, email, reach out. Thanks very much.